Are we overbought here? And if so, how do you handle the market?
Hey, good morning, Alex. Good to see you. So I don't say we're overbought, but we do have 96% of the S&P trading above the 200-day moving average. So it's a healthy rally. It's an everything rally. And it's a rally brought about because we're having better than expected economic data, better than expected earnings, and of course, yields, surprisingly, have really come off that spikiness that we saw in February and March. So it's allowing everything to move. The question is, what do you do from here? So being positive on the market is not the same as expecting it to go up in a straight line. And when you have a bounce off the bottom, and when you have a recovery after a recession and bear market, the second year tends to be a bit more tricky. And it's trickier because certain sectors win and certain sectors lose, and some sectors may have overrun their earnings and growth expectations. So we think you should be invested, particularly if you're holding stocks for more than a year or two. You should be invested. We think ultimately the kind of bullishness we've seen in the upward action and the breadth of the market means 6 to 12-month returns from here will be higher. That is the case historically. But, there are pitfalls along the way, and we shouldn't be surprised to see it. It's entirely consistent with an upward moving market, really in the beginning stages of a recovery.
Alicia, you like industrials, you like materials, you like energy, anything related to the housing market, and large cap tech. You even are starting to like Europe. These are areas of the market that have done pretty well. I know large cap tech has faded a little bit, but I'm wondering how much juice is left in some of these trades. The housing market has been on fire. If people haven't noticed that by now, they've been missing something massive happening in the economy. Why isn't all the good news already there?
So it's not already there because, I'm looking at the bond market. I think the news out of Europe in the last few weeks was part of the reason that we saw the sell-off in the cyclical sector here and in value in the U.S. And I think this is actually a great entry point to come back in because, again, the earnings growth this year is going to be driven by the cyclical sector. The growth itself is not being driven by tech or by growth stocks, but actually by the cyclicals. And that's going to be the same. That's going to be true for all 4 quarters. So given that, we just think there's earnings upside more coming from the cyclical sector. And that's why we're actually positive on Europe, despite the headlines. I mean, the headlines in a funny way sometimes are the last thing to follow what's priced into the market. Because ultimately, if you believe in growth, if you believe in higher rates and higher inflation, then Europe's market is mostly cyclicals and value and less so tech, which is why it's underperformed in the decade after the global financial crisis. So we think there's an interesting opportunity here, and it runs counter to what the general sense is out there. As for housing, yes, housing has moved. Wouldn't be surprised to see a pause. However, we're in the beginning of a secular uptrend, meaning we lost a generation of home buyers after the global financial crisis. Home ownership was actually the lowest that it's been in the U.S. since the early 1970s, and so we're beginning to correct that kind of extreme action. And in a sense, you have 2 generations of home buyers right now. And so what we think is this is sustainable. I mean, ultimately, you're looking not for the bounce, but you're looking for the sustainability of sectors and of earnings. And let's talk about inflation expectations for a second. If you go out 10 years, investor expectations, market expectations are 2.4% inflation.
Yeah.
Think about what happened after the global financial crisis, 1.8. That is a permanent change in forward-looking inflation expectations.
A quick thought then on Europe, going to that cyclical trade. At the same time, you're going to then have a stronger euro and higher yields. Goldman Sachs just said you want to sell the 30-year bond, just outright upgrading their euro dollar call to 125. Does your cyclical trade hold if we see bonds at 0, if we see that hot, stronger euro?
Yeah, look, I mean, you're already seeing it in the German Bund. I mean, the German Bund is moving faster and higher than the U.S. Treasury. The spread is closing there. Very, very interesting. I expect the U.S. Treasury yields to start moving higher, too. I mean, last week was a gut punch for those of us who just expect higher inflation and higher yields. But that's the market doing its thing, overcorrecting a crowded trade, which essentially is what we believe happened, along with some negative headlines. We think the yields are moving higher. It's actually a great entry point for that kind of trade. But let's talk about large cap tech. The future is digital. End of sentence. We all know this, and it's happening in every single industry. You have to be levered to profitable tech because profitable tech is going to grow through all of this. Higher yields won't bother it as much as higher yields will bother speculative tech. So go for the names which have earnings, real businesses, and can lever their business models to the uptick in the economy. So you have to be really everywhere. Again, it's the everything rally, maybe not bonds. And, we think in terms of equities, you have to be in it. And we would use upswing, sustainability, and the beginning of the upswing and the beginning of the earnings cycle to invest here. Earnings are going higher. I mean, they're higher and they're going higher. And I think that's the message here, including to 2022.
Alicia, one final quick question. The US appears to be winning its battle with the virus because of the vaccine. Europe is starting to play catch up. China's looking pretty good. The numbers are fantastic. But the rest of the world isn't. Are we missing something here about the risk potentially to this rally, this recovery that seems to be isolated to the developed world right now?
Look, if the U.S. is recovering and China is recovering, then the rest of the globe will recover. I mean, that's the simple math of it. However, I do think there's higher risk. We're not especially pushing on emerging markets simply because I think there's some political risk there. What you point out is not just a slower rollout of the vaccine, but increasing rates of COVID infection. And with that comes some of the normal risks that go along with emerging market investing. So I think there just has to be some care there. But the overall picture is if you have developed markets growing, and we do think Europe is a bit of a postponement, but it's not a change in trend, right? It's just it's behind, but it's catching up. Then the rest of the world will grow. And I think ultimately being optimistic and being forward-looking and thinking about the best case scenario, frankly, has really been what's driven markets. I mean, let's face it, we are in a V-shaped recovering in markets and in the real economy.
Right.
Pauses here and there, but we're getting back to Q4 2019 GDP by the summer here in the U.S.